Martin Zweig used these three indicators to understand monetary conditions in the stock market. By the way, learn to buy the dip like a pro with my value investing course on Warren Buffett. Martin Zweig believed that monetary conditions had an enormous influence on stock prices, and that these three indicators were some of the most effective ways to monitor it. 1. The prime rate indicator. The prime rate is the interest rate that banks charge their best customers, the major corporations. It lags behind the federal funds rate, but when it does change, it causes changes to the market. Zweig believed that if the rates are below 8% and in a downtrend, or above 8% and dropping a lot, that's a bullish sign. But if they're increasing and above 8%, then that's a bearish sign, especially if there's been more than one consecutive hike. 2. The Fed indicator. Zweig believed you should never fight the Fed and should always know if they're doing quantitative tightening or easing. They determine the discount rate, the Fed funds rate, and the reserve requirements. If they decrease the discount or reserve rates, it's a bullish sign, and if they increase them, it's a bearish sign. 3. Consumer installment debt. Zweig explains that when demand for loans rises excessively, it puts upward pressures on rates and vice versa. He believed that if the year-over-year change of the consumer installment debt was falling and fell under 9%, then that's a buy signal. But when it's rising and hits 9%, then that's a sell signal. Do you think these indicators work? Like and follow for more.